Hi, I'm Andrew Kirsch, co-founder of Sklar Kirsch. On this podcast, I interview industry leaders. You'll hear their real-time opinions on today's market, their background, unique career highlights, and guidance for newcomers to the industry. This is the Kirsch Connection. Welcome to another edition of the Kirsch Connection. My guest this week is Paul Julian, the president of Advanced Real Estate. While many people have focused in buying multifamily throughout the country and the Sun Belt, Advanced Real Estate focuses on buying just in Southern California, and in particular, buying in the city of LA, when many institutional companies and institutional capital have redlined the city of Los Angeles. Paul and Advanced Real Estate are diving in. So in this conversation, we talk about why he likes Southern California, why he likes the city of LA, why he made a $200 million acquisition of newly constructed multifamily in Hollywood, and how he and his father, who is an adept user and reader of the tax code, of how they're always trying to figure out to broaden their investor base and using the tax code and advantages that their investors can capitalize on. I hope you enjoy my conversation with Paul Julian. Welcome to another edition of the Kirsch Connection. I'm here in front of a live audience with Paul Julian, the president of Advanced Real Estate. Paul, how you doing?
Great. Thanks for having me.
Thanks for coming up from Orange County. You brought a crew, your son, and other guests. So hopefully we'll have a little laugh track and maybe some live audience participation.
Yeah, that sounds good.
So to the extent, if my audience doesn't know about your company, about Advanced Real Estate, just go high level for now, and then we'll do a deeper dive later in the show. What do you guys do?
Sure. Our company's been around a long time. We were started about 45 years ago by my dad, and he's still super involved today. He's CEO, and he's still coming in and leading our company. But we were started with a principle of buying multifamily real estate in Southern California and holding it long term. So very simple. We just buy and hold. We never sell. We don't use any institutional capital. Everything is private, friends and family. We're now up to about 1,000 investors. We have about 13,000 apartment units in Southern California, worth about $5 billion. And we're vertically integrated. We have in-house property management, construction. We have a very unique investment structure. That's kind of what sets us apart for all these individuals, which we can get into a little bit if you'd like.
So you said in-house construction, and I see some of my clients' locations, and you invited me down to your office in Orange County, and at first, you feel like you're in a normal real estate professional's office, and then you open up this back door, and it's this gigantic industrial complex of manufacturing and light manufacturing and of construction goods. I was blown away. So tell my audience, what your facility and what you do at your site, because it's not just acquisitions and property management.
All right. Well, we started many years ago. It was back probably 20 years ago. We were right before the GFC. There was a lot of building going on, as you know, and we were having trouble getting subs to come work at our properties to put in cabinets or do any renovations because they were so busy. Everything was being built. They were on other jobs, and so when you have apartments, they're sitting vacant for a couple of days, you're losing revenue. So we thought, how do we take this in-house? So we started bringing guys in and giving them some saws, and they were building cabinets for us. And then pretty soon it turned into a bigger thing in Anaheim, and then ultimately we consolidated in Irvine into about a 50,000 square foot facility we have down there. And we've made everything in-house. I mean, in-house plumbers, electricians, HVAC, painters, framers, even building our own cabinets. So we have a full cabinet shop down there, CNC machines, and we're able to control the quality and the speed of the renovations. And that's important to us because we have this philosophy of holding forever. We never sell. So if you're going to put in cabinets, put in ones that'll last for 30 years, right? And, we can all obviously change the faces with trends, but the box can last for 30 years. So that's the philosophy of our company is hold forever, and stay within 50 miles. That's kind of our radius. Maybe it's a little bit, we're going to expand down to San Diego at some point probably and out to, maybe Ventura County, but right now we're LA County, Orange County, Inland Empire, all of our assets, 13,000 assets or units all in in that market.
It's interesting. We transact nationally, and we represent clients who may be based in Southern California, but they've been transacting in the Sun Belt or the Pacific Northwest or Florida. And coming out of COVID, there was such a emphasis of buying in those Sun Belt markets, and now those markets are struggling with oversupply and negative lease trade outs and significant lease concessions. Did you ever feel when your peers were buying up properties and basically like day trading real estate, right? and flipping real estate so quickly in the Phoenixes and Vegases and Orlandos, did you ever think, gosh, we should get out of Southern California? Or not totally, but like start buying outside of Southern California?
I mean, you certainly thought when we had the exodus during COVID of a lot of people moving out of state, you start thinking, gosh, is everyone going to leave? And then you go, no, there's no way everyone's going to leave Southern California. And so we've gone through a few cycles. We're a little older. We've been through it. And I remember right before the GFC watching those markets suffer first. We're looking at companies that were losing assets in Vegas and Phoenix and Texas, all the markets you're talking about. Our philosophy has never changed, and that's we have such high barriers to entry in Southern California. What do people complain about in Southern California? They complain about the traffic, the regulation. Those are all the things that keep our buildings full, if you think about it, right? At the end of the day, when you look at economics, your first economics class in high school, the first thing they taught you is supply and demand, right? So you look at Southern California and you go, we have very low supply and super high demand. And it's not going to change. They're not making more land here. And it's not getting easier to build. As much as we've tried with regulation, it still has not gotten easier to build, really. So you go to those other markets and you look at, Phoenix and Nashville and those places, you have plentiful land and very easy entitlements, right? So you're always going to have an oversupply in those markets. So we just, if you look at our occupancy through the years, it doesn't really change much. We stay about 95% occupied. You look at our rents and they just steadily go up every year. You don't have these big roller coaster years like you do in those markets. So we've just chosen to stay in this market and we can operate it all from our hub in Irvine.
Yeah. Now I feel like there's, my clients who have properties both in Southern California or coastal markets and Sunbelt have all said, that their coastal market properties are outperforming their Sunbelt properties significantly, but that they are looking for, business-friendly communities within a coastal market. So they may not go into the city of LA, but they're willing to go into surrounding markets that may be more business-friendly.
Right.
But you're also buying in the city of LA. And so what is your feeling today? We've got a mayor election. We've got a lot of political challenges, regulatory challenges, crime, homelessness. I know you live in Irvine, but you do business in LA. I mean, what is your thoughts on the city?
Yeah. Our office, right, is in Irvine. I live in Newport Beach, which is same, Orange County market, very different than the city of LA. But I lived in LA for a long time, and kind of during the heyday, all through the early 2000s when it was really gentrifying. It was in Hollywood and downtown, working in downtown, and I saw LA in its prime, and that hasn't left me. I think LA can come back to that at some point. We're nimble. We have the benefit of being all privately funded. So I'm looking at LA and saying it's not going away. The city's not going to be gone. It's not like a Buffalo, New York, or Detroit or a Cleveland where there's no reason to be there. Once industry leaves those places, why would you go back? It's not like there's good weather or anything. LA, we have an incredible piece of land here, right? I mean, it's the best weather in the world. There's great transportation, there's amenities, there's everything you want here. So I don't think it's going away. I think it's hit some stumbling blocks over the years. In the 90s, we had some stumbling blocks in LA, same thing. And I think it will be back. I mean, the other day I took the subway, in LA. And,
you're the one.
Yeah. I was down there going, it was spotless, and maybe it was just the day I was there and the line I was on, but things are cleaning up a bit. And I think with the Olympics coming, things are cleaning up even more. We take advantage of times when the institutions are out. and institutions have been out in LA. And so we've been able to go in and buy at incredible prices. I mean, we just bought, the largest deal in Southern California was the $202 million Hollywood purchase we made from Kilroy. 2 high-rise towers in Hollywood, Class A, Type 1 construction, glass and steel, irreplaceable real estate. Probably cost well over $1 million a unit to replace that. We bought it for $513 a door.
And when was it built?
One was built, there was 2 towers. One was built in 2016, and the other was built in 2021.
And so what is the thesis there? Because you said you're going in when when institutions are not. And
Right.
I hear it daily. In fact, I talked to my city council member, Tracy Park, who knows that institutions have redlined LA. And here you're coming in, making a big bet, big 9-figure bet on LA. What did you see specifically about this opportunity that you liked?
I think, number one, how insulated we are there because our basis is so low. You're buying at $500,000 when it's well over $1 million to replace it. So if I go, okay, who's my competition? There's only actually 5 high-rise apartment buildings within Hollywood proper, within the boundaries of Hollywood. We now have 2 of them. We have 60% of the units, so we can kind of control that high-rise market a little bit there. I'm looking at the basis going, the rents we have to charge are not crazy. We're at 97% occupied right now. The entertainment industry is bumping along in Hollywood, and however, I don't know if you saw the report. $6.6 billion was just generated on the latest tax credits they did. So it's starting to work to bring some production back to Hollywood, even if there's no production in Hollywood. It's still a great place to be. I would buy those assets in a market that had zero entertainment industry, anywhere in Southern California. For that basis on those assets, I would buy it.
Yeah.
So Hollywood, you get the benefit of the industry that is there, and the industry is changing, right? It's not going to be your traditional filming. It's a lot of different type of content. Our buildings are full of content creators. We have, many people that you probably see on social media that are, they're creating there and they're creating in Miami. Those are kind of the 2 hot spots where a lot of people are creating. We have athletes, we have, celebrities. It's in a lot of business professionals there. It's just a big mix of people. It's a great diverse market.
Now, when someone is taking down a $200 million plus asset, I would say all but maybe 1 or 2 clients of mine would need institutional money.
Right.
There's a group down in San Diego who's a client of mine who may be able to do this through a syndication. How has Advanced Real Estate been able to put yourself in a position where you could buy an asset of this size through a syndication? I mean, that seems like it's the holy grail of capitalization, because look, the pros and cons of institutional joint venture real estate structure. The pro is, one-stop shopping. You're able to do larger deals, but the con is you've got someone who's basically telling you what to do. You're working for them, right? They've got the major decision rights, and they should, because they're probably putting up 90 to 95% of the equity.
Right.
But you don't need that type of money. So how has your company been able to put yourself in that type of position?
I mean, I think a lot of it is just the track record, the many years of doing it. You get to a point where we started doing a fund structure in 2020. Before that, it was single asset purchases. And the deals were getting so big that we were having to raise $30 million in 30 days to close a deal, which, we wouldn't sleep for 30 days trying to collect all the paperwork. And we're always able to raise the money. It was just a lot of work to do it. So we said, let's get a discretionary fund going so that we have the capital, we'll be better buyers. And a lot of our first fund was seeded with refinance proceeds. So our whole business philosophy is go buy, renovate, hold, and then refinance. Take those proceeds, return them back to our investors. And our investors, I'd say 95% of them turn around and give the money right back and put it in our next fund. So that always seeds our next fund. So we always have a good chunk of money in funds from refinance proceeds. And then we open it up and raise some more money that way. And we've been able to raise a lot of money through people using retirement accounts. We have a pretty cool structure we've come up with that's kind of hyper boost their tax write-offs that they get personally, but they let the retirement fund put up their retirement account, IRA, 401k, put up the majority of the money. And so it's allowed us to raise a lot of money where we can have a couple $100 million in a fund and, show a broker and show a seller, look, we already have the money raised. We could close tomorrow. We'll, still get a loan. We're select sponsor with the agencies. But it's allowed us to buy, especially when a REIT needs a quick close, we're reliable. We don't have to go to an investment committee. My dad and I are making that decision, so it's pretty quick for them. They want to do a deal with us versus an institution.
And what's the profile of your investor? High net worth individual, family offices?
It's funny. We actually have the whole gamut. Because of this retirement thing, you wouldn't believe how much money a firefighter, a public employee, a teacher, that they have saved up in their retirement account that they're able to self-direct. And a lot of them are scared of the market. They don't want to put their money in the stock market. They don't know what that's, with AI and all the things happening, what are those companies going to be like in 5 years? They don't know. But a tangible piece of real estate that they could self-direct into, they're confident about that.
And how do you connect with these people? Are you using social media? Are you going out? You have a large investor relations team that's promoting your fund?
Really, it started as friends and family and word of mouth. When you have a good track record, since we never sell, we do long-term fixed rate financing on our deals. So we've never had a loser in 45 years of doing this, so nobody's ever lost money because we never have to have a gun to our head to have to sell, so we just, it's word of mouth. We are going to start doing a little more social media marketing potentially on it. I've always been very hesitant with social media, but
until today.
But now we're going, maybe we embrace it in a professional way. I mean, I think it has a bad rap because I think there's a lot of, different personalities on it. And
I think I know who you're talking about.
But I think you can do it professionally, right? And raise a lot of money. I mean, a lot of people are doing a great job raising a ton of money that way, and it's almost a crowdfunding. And someone who's using an institutional partner can't do that, right? But since we're actually primed to use social media. We should be using social media because we need to reach a big audience. We don't really, we have some RIAs, a couple that, we work with, but not many. It's really just been a lot of meetings with a lot of people, stuff like this, get the word out.
I mean, when I met you in your office and you were taking me through your deck and the way you're able to juice returns, I felt was unique compared to the rest of my clients. I don't know if you want to elaborate even more. I know you scratched the surface, but I know you had multiple pages, which we're not going to get, show it on the podcast, but if you can talk about it, I thought it was quite innovative, yet also seems fairly intuitive. I think you said was it your dad who just likes to read the tax code?
Yeah.
Was I right about that? Did I remember that? So talk a little bit more
Sure.
about why investing with you, that how you structure it, just provides more benefits to the investor.
Sure. Yeah, my dad's the zany professor. I mean, he's unbelievable when it comes to tax strategies, and he's done a great job coming up with these over the years. And we've always refined it. With 1,000 investors, we see everyone's situation. Some people need, a certain, structure because they have estate planning needs, and some people need it for, there's many different reasons people need things, and so we've tailored it. And it's sort of our secret sauce, so I probably won't get into all the details
Sure.
of it, but it's, basically the concept is your retirement fund's doing the heavy lifting and you're not having to put a lot of personal money in, but your personal side is getting a lot of benefit. It's getting a lot of upside. It's getting a lot of tax benefit. And so we spent many years coming up with this. And when people hear it and they look at it and go, okay, my retirement account is not doing anything for me right now. It's just sitting there locked up and I'm not going to touch it till I'm 60s or 70s. And I don't want to wait that long. I want to use that now. And so that's kind of our pitch, that let's free that up today. And that appeals to everybody. I think it's a $13 trillion market, of cash that people have locked up in America in these retirement accounts that they're not using. So that's sort of our pitch.
And evergreen, never. So you replenish the investors' cash through refinancings, and then they redistribute it or reinvest it in subsequent investments, and that's basically the treadmill that you have created.
Yeah, it's funny because we'll have investors that have been in deals for a long time with us, and we've refinanced them out 4 times over the years, 5 times. They've gotten their money back multiple times. And then they'll say, well, what's our exit strategy? And go, you've already exited. You've exited many times. Forget you own it, because you can't sell that share. You'll have to recapture all that tax, all the losses you've taken. So they kind of just forget they have it, and they pretty soon that one they forgot about, it refis again. So they get these streams of cash flow from all the deals, and they keep rolling and rolling, and pretty soon they started with one investment with us. Now they're in 10, and they're all cash flowing with periodic refinances on each of them. You just got to keep rolling.
Do you ever feel like, okay, it's time to sell an asset that it's had its life, that we can't squeeze anything more out of it, and let's 1031 into a newer asset?
Yeah, it's funny. I mean, in Southern California and California in general, we have Prop 13, and so it's hard on these older assets because we have such a low property tax base on them. They're going, why would we sell? I mean, property tax is such a big part of your expense, piece, that why would you sell it? So we just keep. I know a lot of them are out of depreciation at this point, but if you keep rolling into our new deals with cost segregation, you have so much write-off on the new deals that even if the old deals are taxable, you can offset it with the excess that you have on the deals you just bought now. So our investors don't end up paying any taxes. I mean, it all cancels out as long as you keep investing with us.
Yeah. So you mentioned that your father started the company, about 45 years ago?
45 years ago, yeah.
And so what did you do? I mean, we hadn't even gotten into your background. So, after college, what was your first foray into real estate, or was it even real estate?
Yeah, it's funny because I brought my son up with me. He's off on summer break right now. I brought him up with me today, and it reminded me when I was a kid, when I was, I think, 10 years old, I started going with my dad to look at properties on the weekends, and we'd drive around. I'd have the Thomas guide on my lap, and we'd be navigating through the streets of Southern California, looking at different properties. And
the days of Thomas guide.
Thomas guide. I mean, that ages you, right?
Google Maps or Waze.
Yeah, exactly. But it helped me learn the freeway system,
Yeah.
and it helped me learn the streets of greater LA. And so I learned a lot that way. And then during high school, I would work, at the company, whether it was, in the renovation department, at the apartments, pulling old toilets out and jackhammering up driveways or whatever it was. I got my hands dirty at the beginning, and then moved into, some of the property management, leasing and things like that, but then really jumped into our investment side of the company, which is, the part my dad and I are running there, and my brother-in-law is involved as well. It's kind of a family company. And then we have another family that we partner with to help run they run the day-to-day of property management and construction, and they do a great job. And so after, high school and college, during college, I was doing that in the summertime. And then, we got out, and my dad goes, okay, time to go get a job after I graduated college. And I wanted to go do my own thing. And so I said, well, what's the biggest real estate company out there? CBRE, right? Let's go there. They're going to have good training. And they did. They had incredible training. So I spent 5 years at CBRE.
Did you want to work for the company, right? Not CB, but Advanced Real Estate?
No, I didn't.
Your dad said don't?
He said no, but I didn't want to anyway. I really wanted to kind of prove my worth and learn on my own and bring something back to the company, And so I grinded. I mean, I was cold calling it, doing brokerage in LA, and was with a great team up here. And then ultimately, I wanted to get on the asset side of the business development side. So I was getting my master's degree at USC. I got into the USC MRED program. And the same day I started there, I started with Rob McGuire Properties.
Right.
So I was doing development for McGuire and learned a ton there. I mean, it was just the go-go days before that whole thing crashed, and it was great times. And then by then it was 2008.
We may have worked together. I don't know if we talked about it, because I was at Latham & Watkins.
Oh, okay.
And McGuire used Latham.
We probably did.
And
back
I
then.
remember sleeping under my desk because of a couple of transactions.
Yes.
One was the IPO,
Yep.
and two, the Commonwealth portfolio acquisition in like 2004, 2005.
Yep.
Maybe it was 10 or 12 properties at the time. I think it was well north of $1 billion. And,
Right.
and we had a conference floor of 25,000 square feet floor plates, and one of the floors was just conference rooms, and literally every single conference room was filled with documents that the general counsel, I believe, was it Mark Lamas or someone else, had to sign. And
That's right.
I mean, just crazy times.
That's funny.
Yeah.
Yeah, he was a legend, right?
Yeah.
I mean, Rob did some incredible things. You look at the skyline of downtown LA. It's thanks to Rob. I mean, Bunker Hill, all those buildings, he built them. So it was a great experience. And then, but 2008 came, and unfortunately, they had the Blackstone portfolio that he bought.
Mm-hmm.
And, it was a tough time. And personally, my wife and I were living, in West Hollywood in a high rise. We were married. She got pregnant with twins, and we're going, you know what? It's probably time to go down. I always wanted to work with my dad, so it's time to go down south and back to Newport and work with him and raise the kids down in Orange County and all that. So I started working with him, and it's been great ever since. We built I think they had a couple thousand units, maybe 2,000 units when I got there, and we're at 13,000 units now, and really enjoying it. I love working with my dad. It's a blast.
And how many employees do you guys have across all facets of the company?
Yeah, I mean, our investment side's, pretty slim, but most of the employees are on the property management
Sure.
and construction side. So we're, I think, 650 employees, something like that, between all the companies.
Do you ever feel like you're not in the real estate business anymore? You're in the people business, that you're managing so many people? Or do you just try and stick with the real estate and you have others who are managing people?
Yeah, like I said, luckily we have a great family that does that day-to-day of the property management and the construction. So it allows really my dad and I to focus on fundraising and deals. And that's the lifeblood of our company, right? Without that, you don't have property management, construction, all those things. So, really keeping these funds going, raising more money and buying great deals. I mean, we look at, well over 100 deals a year, buy maybe 2, something like that. They're big deals we buy. We found many years ago, small deals don't work as well as big deals. The bigger, the better, the more economies of scale. So we got to look at a lot of deals to get 1 or 2 good ones.
So you obviously took down that large asset in Hollywood, and that was a couple months ago.
Mm-hmm.
So we're here recording in July 26. I mean, just what's your overall sense of the market? I've got a segment of, we're blessed. We have a diverse, large client base. So there's always some aspect of our client base who are transacting, and we're definitely doing more offense, more buying than loan workouts and defense these days.
Mm-hmm.
But I've got a segment of my client base who's frustrated that they feel that the bid-ask spread is still too wide, although they may see it a bit narrowing, but it's tough for them to make anything pencil, especially when you are relying on institutional capital and their return expectations are, high double-digit IRRs. I know that's different than what your investor profile is, but I see a lot of folks who are just frustrated that they thought there would be more opportunities and they're just not seeing them. So, and I know sort of a very broad question because every market is a different story and you're focusing on Southern California. But sitting here today, what's your impression of the market?
Yeah, it's funny. I actually like buying when rates are more at what they're at today versus what they were in 2022, 2021. There's not much room for error when you have a 3% cap rate and a 3% interest rate. I mean, what are you going to get cap rate compression? No, not from that. I mean, so we bought some stuff when rates were that low. We locked in 10-year fixed rate financing on that, which I'm happy about. But we see opportunity right now. I mean, when you're holding indefinitely like we are, the loan period is transitory, right? So it's not permanent. So I'd rather get a low basis and a higher interest rate, which is what happened. I mean, we had, rents have gone up and prices have come down. It's a weird phenomenon. It's all capital markets driven, right? It's not really the assets themselves. They're all performing well. So
Right.
we don't really care what the value of the properties are. Once we buy them, it doesn't really affect us. Yeah, we have to refinance them 10 years down the line, but we're pretty safe on that and we don't over leverage anything. So really what we care about right now is the basis. And that's why, the deals like Hollywood made so much sense for us because we're going to own that forever. We're going to be in at a very low basis, which is great. As far as trade, there's not that many trades that are happening out there. I think everyone's kind of frozen. A couple here and there, things are starting to, shake out a little bit. But what we've been focusing on a lot is our other funds. So we have this regular fund that we're buying the assets with, where we use the retirement accounts and the regular cash. But we also have something called our X fund, and that's taken up a lot of our time lately. And we can kind of do that no matter what's going on in the regular market. And the X fund stands for Exchange Fund. And what it is we found many years ago that the baby boomer generation is getting older, and they, a lot of our investors that invest with us are in that profile, and they love investing as an LP with us. There's no liability, there's no management headaches. It's easy. They just collect cash. They're happy. But they say, you know what, Paul, I love that, but on the side, I also own this 10-unit apartment building or 15-unit apartment building or a small strip center or an office building, whatever they have. It's been in our family forever. There's almost no debt on it, or maybe no debt, and our kids don't want to deal with it. I want to get out of it. I don't want to get sued. I don't want to deal with the management. How do I get out of that? And you look at their options, and they're pretty bleak. They don't want a 1031 exchange out of that into another apartment building where they have the same problems. So what do? They can 1031 exchange into a triple net lease, which really those aren't that great because typically you're going out of state with it. You're putting all your eggs in one basket with one tenant.
Yep.
Your financing's not as good. Your tax benefits aren't as good. You can't always keep up with inflation on those leases. So that's not a great option. So what else can they do? Maybe a DST type thing, which, I don't want to disparage DSTs. It's a great option for people who are kind of at the end of their 45-day identification period. And but a lot of those, you're kind of just kicking the can down the road. And 5 years from now, you have to, they're going to be selling those assets. You got to make another decision then. So we came up with this X fund and said, why don't you contribute your properties in via 721 into our fund? We'll take care of them and manage them for a couple of years. And then we'll conduct a 1031 exchange into a nice big Southern California institutional asset like the rest of our portfolio. And so it's a way for them to seamlessly get out of their real estate that they don't want to deal with anymore and become an LP, protected, cash flow, easy to distribute to their heirs someday.
So it becomes your headache.
Becomes our headache.
So you are now, you bought, Kilroy's properties,
Sure.
These jewels in Hollywood, A-class properties. And at the same time, you have people on your payroll who are managing a 10-unit apartment building that someone has exchanged into this or contributed into this X fund. I mean, you've got a lot of cats and dogs.
We do.
And other animals.
We even have single-family homes. We have people who, I was talking to someone today who they have a house down in Orange County that they bought or built for a couple $1 million, 15 years ago, and now it's worth, $10-15 million, and they can't sell their own primary residence without paying a ton of taxes.
Right.
Because you think about it, you get a $500,000 exemption if you're married.
Yeah.
That doesn't do much when you have $8 million a gain on a house or something like that. So they can actually put their own home into this X fund.
Is there any type of property you will not take?
We'll even do land. We'll take land in it. I mean, any property really we can take, and it could be all over the country that we take in. Ultimately,
How long have you had this?
Since 2023.
Wow. Okay.
So we're finishing our first round trip because you really want to hold these for a couple years before you do the 1031 exchange out. And so the first ones we took in the X Fund 23, we have on the market. We're selling them right now. Some are in escrow, and we already have the deal tied up because the important part is what you're getting into. So we tie up the deal we're going to buy first, get it in escrow, and get a nice long escrow. Give us time to sell all those assets, and then we conduct the 1031 into that. And the seller of that big asset we're buying, they're still confident because we have our other fund that we can backstop if we don't sell these little properties in time. So we've kind of covered our bases there.
Wow. And have you had to grow headcount in order to properly asset manage all these types and locations of real estate?
We've grown a little bit, a couple people here and there, but like you said, we asset, like if it's out of state, we'll be just kind of asset managing it. We'll keep the property management company in place that's out of state.
Yeah.
And a lot of the small deals around here, we actually have another property management company we've teamed up with that focuses on small assets to manage that. Because our property management company is used to, 100 units is our minimum size. Everything's bigger than that. So they're used to that kind of an asset.
Yeah. So obviously your son is here, John Paul. Not to put you on the spot, John Paul, but I get asked. I assume you get asked from those that are graduating college. Maybe they're graduating high school. With AI and just way the industry and the world is moving, I want to be in the real estate business, but I'm not sure like how to get in or what aspect of the real estate business I want to start my career. And you've worked on the brokerage side, you've worked for an institutional office landlord, and obviously your own business with your father in multifamily. So if you're talking to a 22-year-old who's graduating college and they want to be in the real estate business, what advice would you give them?
That's a great question. I think it's smart to be up on all the new technology. Be really good at AI because it is going to have its own place in real estate. But I think real estate is a smart move for somebody because assets are tangible. You need a place to lay your head at night. I think apartments, the other asset types in real estate maybe are a little more volatile with office and retail and industrial, but apartments, you still need a place to live. I don't know if all the robots will need a place to sleep. Maybe we could fill some of the apartments with those guys. But I think it's a good spot. I think if you're young though, I think go read everything you can, learn everything you can learn, grind it out. Maybe go work for somebody big. I really think working at CBRE was great for me. Their training was incredible. See how the big guys do it before you try to do it on your own. You're going to learn a lot from that. But I think it's a good business. I think you can maybe make, a ton of money in AI, but I also look at that as maybe a bit of a bubble right now. I mean, the SpaceX thing and Anthropic, all these AI companies that are IPOing these huge numbers, can that sustain? I don't know. It feels a lot like back in the tech bubble in the 90s. You remember that?
Of course.
Late 90s when people were starting, .com businesses that were doing, whatever, .com for everything. And they were raising a ton of money, but none of those companies were making any money, right? In real estate, the real estate has to make money. I mean, you really have to have cash flow to get investors to go into it. You can't not make money. So it's funny that all these investors are going into these, stocks and AI companies that don't make any money. It's tough for me. I like to see cash flow.
No, I get it. And then I guess sort of final question, it's obviously a marathon, and with your company, it's 45 years, so many marathons. Those that are perhaps leaving their institutional job, they want to be entrepreneurial. They know that, obtaining capital is the lifeblood of their existence and how they can do deals. And so any advice on how one can amass, the type of syndication portfolio of investors that you guys have? I mean, is it literally just one coffee at a time, one breakfast at a time, and it just snowballs? I mean, what in terms of that type of investor profile, it seems so daunting for a 30-year-old who's leaving, not McGuire, but another company, and saying, okay, I want to do this on my own, but we're making money, but it's not enough to support a family and private school and all that. But in 20, 30, 40 years, you're sitting on quite a portfolio.
I think you just said it right there. I mean, the 20, 30 years, I don't think this is, my dad always say that, we're the tortoise, not the hare in our business. The tech company, IPO, young guy that makes a couple $1 billion, that's the hare, and it sometimes works, but our business is experience. And I would caution a young person who doesn't have experience, don't go raise a bunch of money before you've done deals, because I've learned something new on every deal I've done. And if you go raise a bunch of money and then you lose it for people, it's going to be hard to crawl back and get people's respect and get people's trust back. So you got to put in the years. I mean, the real estate business is it's a long-term business. It's a relationship business, and it's an experience business. Like I said, you've got to learn from every single experience you have. So if you are going to jump out of it, save up, be ready, live frugally for a while, because it's going to take a while to get to that point where you have enough investors to have enough cash flow, enough fees, enough everything you need to really sustain a lifestyle that way, like you're talking about.
Yeah. Well, Paul, I'm glad that you and I were introduced. Thank you so much for making the trek up the 405. I'm glad you brought your entourage. My only guest who has, bodyguards and kid. No, I'm just kidding.
Yeah, right.
It's a great, it's great to see your son here. And I just love hearing the story of you, your father, advanced real estate, and much continued success to you and the company.
Well, thank you so much. This was fun, and it was great, spending time with you. And good luck to your son. I know he's about to play a big baseball game, I think, tomorrow. So
that's right.
Good luck with it.
A big tournament for Maverick and the Santa Monica 90 Pony.
That's great.
All right, Paul. Thanks again for coming on, and that's another edition of the Kirsch Connection.